Welcome to Philip Shue Podcast.
When we talk about real estate, we think of it as this incredibly physical, unchangeable asset class.
Right, yeah. It's literal concrete and glass.
Exactly. You buy a premium apartment in a massive global financial hub, and, it feels as solid as the bedrock it's built on.
Oh, absolutely. It provides this profound psychological comfort. I mean, a skyscraper isn't going anywhere.
Yeah.
It gives this illusion of absolute permanence, which is why capital naturally flows toward it when things get uncertain.
But what happens when the invisible infrastructure of our economy, starts to rewrite the value of that physical space?
Well, that's the real issue right now.
Right, because
Okay.
we are looking at a landscape today where software is actually altering the underlying wealth of the people who buy that concrete.
Yeah, it's a fundamental shift.
And that brings us to the core of today's deep dive. We are speaking directly to you, our listener, unpacking a custom executive strategy memo designed specifically for your investment portfolio.
It's an incredible document to go through.
It really is. Your target is the Hong Kong property market.
And, it sits right at this fascinating intersection of macroeconomics theory, technological disruption, and the very localized, unique behaviors of Hong Kong real estate.
Yeah, it maps out how a foundational market is about to just fundamentally shift.
Exactly.
Okay, let's unpack this. The core thesis you've laid out in this memo is that artificial intelligence acting in tandem with the physical integration of the Greater Bay Area, the UBA is, it's going to gradually weaken Hong Kong's premium white-collar income base.
Right. We are talking about the high-earning financial, legal, and administrative layers that historically, prop up those property values.
People renting those luxury flats in Central.
Exactly. And that is a crucial distinction. We aren't just talking about a cyclical downturn here.
Like a normal recession.
Right. We are analyzing a structural drag because historically, Hong Kong has relied on this highly compensated, specialized workforce acting as the gateway between global capital and mainland China.
But AI changes that math.
It drastically reduces the headcount needed for complex financial modeling, legal discovery, administrative compliance, all of it.
Wow, yeah.
And simultaneously, the GBA infrastructure like high-speed rail integrated data networks, it creates this geographical release valve.
So people don't even need to be in the city.
Precisely. Corporations can suddenly shift their operational footprint just across the border to Shenzhen or Guangzhou.
Where overhead is a fraction of the cost.
Exactly, without losing their connection to the global hub.
So it's a double hit. AI shrinks the sheer number of high-paying jobs, and the GBA infrastructure allows the remaining jobs to be physically relocated.
It's a squeeze from both sides.
But wait, doesn't everyone always say interest rates are the absolute boss of real estate? Why is income confidence the ultimate decider here? If we see aggressive rate cuts and mortgage servicing becomes cheaper, doesn't that inherently drive property values up, regardless of a shifting labor market?
Let's complicate that a bit because your memo handles this dynamic brilliantly. Interest rates are essentially short-term triggers.
They dictate liquidity and the immediate cost of capital. But income confidence, specifically the debt servicing capability of a high-earning demographic, that is the absolute bedrock of long-term valuation.
I see.
Think about it from the perspective of, a senior executive making a long-term capital commitment.
Right.
If you are deeply uncertain about the future of your role due to enterprise-level AI adoption, or, you suspect your division might be relocated to a lower-cost center within the GBA.
Then a rate cut doesn't really matter.
Exactly. Your sensitivity to a 50 basis point drop in interest rates is essentially zero. You are not going to take on a massive 30-year debt obligation in a premium Hong Kong district if you don't trust the durability of your future cash flow.
Yeah, that makes total sense. Yield spreads and cheap capital only matter if the buyer actually wants to buy.
Right. The buyer has to feel secure.
It's kind of like termites in a house.
Oh, that's a great way to put it. Right. A rate cut is just aesthetic. It's slapping a fresh coat of paint on a building's facade. It makes everything look vibrant and healthy for a quarter or two.
Meanwhile, the termites are eating away.
Exactly. The underlying white-collar income base is the load-bearing wall. And that wall is slowly being hollowed out.
If we connect this to the bigger picture, because that erosion is gradual, it creates a really fascinating distortion in the market.
Oh, so?
Well, the structural integrity is compromised long before the facade actually cracks, which, forces us to look at how a market like this actually reprices.
And that is the billion-dollar question for you. listening right now, because markets don't just wake up one Tuesday and drop 20%.
Usually not, no.
Your memo outlines a very specific, unique behavioral sequence for Hong Kong, starting with this illusion of stability we are seeing right now.
Yeah, the 4 phases. We can think of the first phase as a state of suspended animation or warm water.
Right, warm water.
Currently, the surface level metrics don't look terrifying. Prices might be relatively flat, perhaps experiencing minor localized upticks.
But something is missing.
The critical metric is missing. Transactional velocity is severely depressed.
Volume is just dead.
Completely dead. Which leads to phase 2, the no buyers or frozen market.
It's the Wile E. Coyote effect, isn't it?
I love that analogy.
Like, the market has run completely off the edge of the cliff, but because it hasn't looked down yet, it hasn't fallen.
Yeah, his legs are just spinning in the air.
Exactly. The buyers have quietly retreated due to that hollowing out of income confidence, but the sellers simply refuse to adjust their expectations.
Yeah, and that behavior is a really distinct feature of Hong Kong's market architecture.
Because they don't have to sell.
Right. You are dealing with a demographic of sellers who historically possess immense holding power. We are talking about deep, multi-generational equity and landlords with very little leverage.
So they aren't forced to do anything.
Exactly. Because they aren't facing immediate distress or crippling carrying costs, they simply anchor to yesterday's valuation.
So if someone offers them 20% less, they just say no?
They withdraw their listings rather than take a haircut. The market doesn't crash. It just entirely seizes up.
So we enter this massive standoff, a completely illiquid environment. But here's where it gets really interesting and where your memo issues a stark warning to the listener.
Yeah, this is crucial.
When we see this utter lack of liquidity, when buyers vanish and the market goes silent, human nature tells us that this is the bottom. Like, this is the moment to jump in and find a desperate seller.
Right, and acting on that instinct in Hong Kong would be a critical misallocation of capital.
Why is that?
What's fascinating here is the memo points out a mechanical lag unique to this specific market environment. When macroeconomic pessimism sets in, liquidity evaporates first.
Okay.
Price adjustment is a trailing indicator. It sometimes lags by 6 to 24 months.
Oh, wow. So for up to 2 years, we could just be looking at a giant cargo ship that has completely cut its engines.
That is a highly accurate way to visualize it.
It's no longer being propelled by buyers, but it has so much historical momentum, so much seller holding power, that it just keeps coasting forward through the water as if nothing is wrong.
Yeah. The sheer friction of the market keeps prices artificially elevated while the actual transactional volume dies. You are just watching the ship drift.
And the silence isn't an opportunity.
No, the silence of the market isn't the opportunity. It is the pressure cooker building steam.
And eventually, phase 3 hits. The ship stalls out. The pressure cooker has to release, right?
Yeah.
The standoff breaks when sellers finally realize the buyers aren't coming back at the old valuations.
Yes, that is phase 3. The capitulation phase, or the break. That's when expectations fundamentally realign with the new economic reality of a diminished white-collar footprint.
And then phase 4 is the actual opportunity.
Right, when prices reflect reality and cash buyers step in.
Now, your memo draws a comparison to the historical crash between 1997 and 2003, where the Hong Kong property market lost, roughly 60% of its value.
Which is massive.
It's a catastrophic wealth destruction event. Yeah. Are we looking at a systemic collapse of that magnitude as this AI and GBA integration plays out?
It is essential to look closely at the mechanics of that specific historical precedent. The 1997 to 2003 era involved a massive structural repricing, which aligns with your current thesis.
Right.
However, that 60% destruction required a confluence of aggressive acute shocks.
Things hitting all at once.
Exactly. You had the Asian financial crisis triggering a brutal defense of the currency peg, skyrocketing interbank rates, and later, the SARS epidemic.
Yeah, that was a wild time.
That era was defined by forced liquidations. People were dumping assets because their debt servicing costs exploded overnight.
So the distinction is acute distress versus chronic drag.
Exactly. The scenario we are analyzing today, driven by technological efficiency and regional integration, is a chronic condition.
It's slower.
Much slower. Without an unexpected spike in systemic credit stress or a sudden wave of bank foreclosures, the repricing is going to be more grinding than violently sudden.
The illiquidity acts as a prolonged stress test.
Yes, and the subsequent price drop is the market finally exhaling rather than suffocating.
Which brings us to the timeline. Because if you are sitting on significant capital, timing that exhale is everything.
Timing is the entire game here.
We know structural shifts like migrating an entire enterprise's back office to an AI workflow or fully integrating corporate campuses into the GBA, that takes 5 to 10 years to fully manifest in the real economy.
It's a slow physical transition, but the financial markets operate as predictive engines.
They price it in early.
Absolutely. They will not wait 10 years to adjust the pricing. They price in the anticipated reality long before the final transition occurs.
Right, the market prices the future. So let's look at the specific chronology you've modeled. As we sit here in April 2026, your strategy classifies the current period as the tail end of the noise and rebound phase.
Yes. We are essentially living in the final days of that warm water illusion.
The cargo ship's momentum is finally failing.
Exactly.
From there, you project 2027 through 2029 as the period of early cracks.
Right. The first real breakdown in seller holding power.
And then 2029 through 2032 is modeled as the window for deeper repricing. In terms of the actual hit to valuations, your base case estimates a structural decline of 15 to 25%.
Which is a highly rational baseline for a market adjusting to a permanently altered tenant base.
But we must also address your tail risk thesis, which is much more aggressive.
Yeah, you've modeled a scenario where a 20% slow decline is suddenly punctuated by a severe 15 to 20% late-stage drop.
Bringing the total wealth destruction to roughly 40%.
It's a significant hit.
A 40% drop in a globally constrained premium land market is massive. What specific catalyst would turn a gradual 20% adjustment into a 40% tail risk event?
Well, it requires an accelerant hitting the market while it is already structurally weakened.
Like what?
If a global liquidity shock occurs, or if local policymakers lag significantly behind the curve and fail to stimulate demand.
Oh, or if we see unexpected localized credit stress where highly leveraged developers are forced to dump inventory.
Exactly. That is when the chronic drag becomes an acute crisis. If those factors align, a 30% repricing is not just plausible, it's a high probability outcome.
But if the real damage takes a decade to play out, why shouldn't the listener just walk away and check back in 2032? Like, why even bother looking for early cracks in 2028? Just park the cash and wait.
That is the perpetual trap of the value investor.
Or pursuit of the absolute bottom.
Yes, the mythical absolute bottom. The reality of capital deployment is that optimal opportunity rarely waits for maximum visible damage.
Price discovery happens in tranches, right?
Exactly. The moment the collective psychology of the market shifts from denial to acceptance, you will see highly attractive entry points emerge across different asset grades.
So if you wait for the binary bottom,
You usually miss the most lucrative, risk-adjusted allocations.
because by the time the absolute bottom is officially declared by the consensus, the smart money has already absorbed all the best inventory.
Precisely. And to successfully navigate these tranches, you have to disconnect from the calendar and attach yourself to the data.
So you don't execute based on the year.
No, you execute based on specific structural signals. You need to monitor corporate leasing velocity in the central district, for instance.
Because corporate downsizing always precedes residential weakness.
Exactly. You must watch the shifting compensation structures and bonus pools for mid to senior executives.
And fundamentally, you watch rental yield compression.
When those metrics demonstrably crack, that's when your entry window is opening.
Okay, so we understand the invisible erosion, we've mapped out the standoff between buyers and sellers, and we've established the timeline of the pressure cooker. So what does this all mean for execution?
This is the fun part.
Yeah, this is where your specific strategic positioning becomes a massive advantage. You, our listener, are holding 5 million Canadian dollars in targeted liquidity.
Which is incredible flexibility.
And your current property exposure is remarkably low, sitting at roughly 20%. And most importantly, you have absolutely zero urgency to act.
That combination, high liquidity and zero operational pressure, is the ultimate asymmetric advantage in a distressed market.
You don't have to do anything.
Right. You are insulated from the macroeconomic drag, which grants you the psychological clarity to act aggressively when the consensus is paralyzed by fear.
You are standing on dry land while everyone else is trying to figure out how to swim in a draining pool.
That's a good way to picture it.
But having the capital is one thing. Deploying it correctly is another. We've established what you must avoid. Do not step into the empty room during the initial illiquid phase.
Phase 2.
Right. Don't deploy capital just because prices tick down 2% and you feel antsy.
The discipline required here cannot be overstated. Your playbook outlines a staggered, tranches-based execution.
So walk us through that. Stage 1.
Stage 1 occurs during that early cracks period. You see the first meaningful capitulation from over-leveraged sellers.
Okay.
At this point, you make a measured small allocation. You are testing the market's depth and securing early value without overcommitting.
Then we move to stage 2.
This is when the broader sentiment definitively shifts. The financial press changes its narrative, the public accepts that valuations have permanently compressed, and the price declines accelerate.
And this is where you deploy a larger allocation.
Yes. And finally, stage 3. This is the overshoot.
The capitulation.
Exactly. If your tail risk scenario materializes and we see genuine capitulation, perhaps driven by that external credit shock we discussed, the market will inevitably overcorrect to the downside.
Fear just takes over.
Fear takes over, and assets are priced well below their structural replacement cost. This is the moment for aggressive, outsized buying.
Mechanically, that stage deployment makes perfect sense. Like you just average your way into the distress.
On paper, it's easy.
But psychologically, how difficult is it for an investor to actually maintain that discipline over a multi-year horizon? I mean, human nature screams at us to either grab the very first perceived discount or, it paralyzes us with absolute terror when we hit stage 3 and the market looks like it's going into freefall.
This raises an important question about behavioral economics, and it is the true test of your strategy. The math is simple, the psychology is brutal.
Yeah.
The most significant returns in real estate are generated by doing what feels intensely unnatural.
Going against the herd.
True opportunity in a market like Hong Kong does not announce itself with fanfare. It appears quietly. It appears when the stubbornness of sellers breaks, the pressure cooker releases, and price discovery resumes at a fundamentally lower baseline.
So the risk isn't macroeconomic right now.
No, the single greatest risk you face right now is a failure of timing discipline. Deploying your $5 million pad too early because the inaction becomes boring.
Which happens a lot.
Oh, constantly. Or freezing up and failing to deploy at all when the optimal metrics finally flash green.
That concept, that illiquidity is the pressure cooker, and opportunity only arrives when that pressure releases into actual price declines. I feel like that is the defining thesis of your entire approach.
It is a brilliantly constructed framework. You are evaluating the market not based on its historical prestige, but on its future structural utility.
Well, let's pull all these threads together. We started by examining how the rise of enterprise AI and the physical integration of the Greater Bay Area are, silently hollowing out the high-earning, white-collar demographic that underpins Hong Kong's property valuations.
Yeah, termite effect.
Exactly. We mapped out the behavioral phases of a freezing market, noting that massive historical equity will cause transaction volume to collapse long before sellers are willing to slash prices.
The Wile E. Coyote phase.
Right. We looked at the timeline, targeting the 2027 to 2032 windows, and ultimately laid out a staggered execution strategy designed to weaponize your 5 million CAD in liquidity when the market finally capitulates.
It perfectly illustrates that holding cash is really only the baseline requirement for success.
You need the discipline, too.
Right. The actual alpha, the outsized return, is generated by understanding the psychological sequencing of the market. Recognizing that a frozen, quiet market is a trap, while a chaotic, downward repricing market is your invitation.
Which leaves me with one final, broader thought for you to consider as you monitor these developments.
What's that?
We spent this deep dive analyzing how software and regional infrastructure are rewriting the physical value of one of the most historically resilient, capital-rich cities on the planet, right?
Yeah, Hong Kong has deep historical reserves, a massive liquidity buffer, and unparalleled global connectivity.
Exactly. So if AI can successfully hollow out the foundational income base and fundamentally degrade property values here, what is going to happen to the physical footprint and the real estate valuations of secondary regional cities around the world?
Wow.
Hubs that entirely lack Hong Kong's financial armor. If the structural shifts we discussed today can eat through the bedrock of a premier global market, how safe is the foundation of a typical mid-tier metropolitan center?
That is a staggering implication.
Right.
It's an essential lens through which to view the next decade of global real estate.
Well, thank you for bringing such a high-level, rigorously analytical strategy document to the table. It has been an absolute privilege to unpack the mechanics of it with you today.
A lot of fun.
Maintain that discipline, watch those corporate leasing metrics closely, and we will see you on the next deep dive.